We have been covering that breaking news. The Bank of Canada, no change to interest rates with their latest announcement, and certainly no change to a lot of what they have been doing, including all that bond buying activity in the marketplace. One of the big questions we had coming into this decision was what they might say about the housing market, and certainly it's been pretty hot, and there was a quick reference to it. But given all the dynamics playing out in the bond market right now, there's been a big question about what's going to happen in the mortgage world, particularly people choosing between, let's say, fixed and variable rate mortgages. David Larock is president of Integrated Mortgage Planners, a mortgage brokerage firm, and he joins us now with his reaction to the Bank of Canada news today. Dave, thanks for being with us. I guess I'll start, given what's been happening in the bond market recently, with what the common questions you've been getting from clients have been in recent days.
Well, any mortgage professional is used to getting the question of should someone choose a fixed or variable rate. And for a long time, fixed and variable rates were essentially the same. And that meant that most people were opting for fixed rates. I think Canadians are conservative in general. And when you're not getting much of a discount for taking on variable rate risk, people tend to just default towards fixed rates. But fixed rates have risen lately. And the gap between fixed and variable rates is already about 0.5% and likely to go even wider. And given that, people are giving a longer look to variable now, and I think with good reason. So really the question now is, should we take variable rates, or are they going to follow fixed rates higher?
It's a great question, and it does seem to fit in a little bit to what we were trying to work through with the language from the Bank of Canada, which, look, they're acknowledging a whole bunch of things that are leading towards what you would normally see when it comes to interest rates rising, but there are all these caveats they talk to as well. And I would imagine in your world, the same variables are at play. Like if you're choosing a variable rate mortgage, and you think that, yes, this other stuff is happening, but not quite to the extent that the bank can really charge ahead with a whole bunch of rate hikes, then ultimately variable rate mortgages might outperform. Can you just give us a sense on what you think the roadmap might look like in the mortgage market over the next year or so?
Sure. Well, we certainly live in interesting times, as if that needs to be said at the moment. One important point to clarify for people who might not know is that variable and fixed rates are priced off of different base rates. Variable rates are effectively priced off of the Bank of Canada's policy rate. So that the Bank of Canada moves its policy rate with lots of guidance. It gives lots of forward guidance on when that might happen, and it's been pretty clear that it doesn't expect to raise its policy rate until sometime in 2023. So if you've got an existing variable rate mortgage, you can feel pretty comfortable that your rate isn't going to rise for at least the next couple of years. Now, 5-year fixed mortgage rates are priced off of the 5-year Government of Canada bond yield. And that yield, of course, goes up or down each day based on trades made by thousands of different investors, and they're worried about higher inflation. So right now, Government of Canada 5-year bond yields are surging. They've surged more than 0.5% in the last couple of weeks. And the Bank of Canada is continuing to provide soothing words to reassure people that its policy rate isn't likely to move until the recovery is well underway. So really what we're seeing right now is a fight about what the future looks like between the bond market, which thinks there'll be more inflation, and because 5-year bonds are more sensitive to the inflation outlook, it's not surprising that those rates are rising first. But really the debate right now is who will be right. Will the Bank of Canada and the U.S. Federal Reserve be right? And will the current uptick in inflation we're seeing now prove transitory? If that's the case, variable rates are a good bet, because if you go with a 5-year fixed rate today, you're locking in a much higher rate than you could have had a couple of weeks ago for the next 5 years, and you could be locking in at the high. But if the bond market is right, then you should be locking in your variable rate at today's fixed rates, because variable rates will rise sooner than the Bank of Canada or the Fed currently expect. That's the debate that's happening right now.
And I guess whoever wins that debate, it has consequences on whether the housing market can continue the pace of growth that it's seen over the past year. We mentioned that the housing market activity made it into the statement this time around, saying that it's been much stronger than expected, which kind of sounds like an understatement when you look at how much these prices have risen. I'm curious, from what you're seeing out there, if prices are going higher, that means people have to reach a little bit more and they have to take on a larger mortgage than they perhaps otherwise would have a couple of years ago. We've talked in the past about, a subset of mortgage brokers that kind of allow and enable that kind of reaching. Are you seeing those kind of shenanigans playing out right now? Are you worried that there are brokers out there that are perhaps helping their clients reach for mortgages that are probably unsustainable if we even get a little bit of a move in rates?
Well, there's no question that's a worry. I mean, one thing, though, that I think we need to remember is that, yes, rates are going up, the rates that people are actually paying, but every borrower in Canada is qualified at the stress test rate. And today, the stress test rate is 4.79%, and that hasn't moved. So even if you're taking on a variable rate mortgage today at 1.5%, you can only qualify to borrow at that rate if your income shows that you can afford for rates to go to 4.79%. So that would take a tripling of rates in 5 years' time when that borrower was up for renewal. Oh, and by the way, that borrower would have 5 years of mortgage pay down to build into their renewal balance. So again, costs are going up, guys, and there's no question that rising rates create more urgency in the market. And certainly I would hope that anybody giving mortgage advice would advise borrowers that just because their rates are low, they shouldn't be changing their buying decision. They should still be thinking prudently about their long-term plans. And let's face it, no one wants to be house poor. But I think it should be, everybody should be reminded that every mortgage today is being qualified at the stress test rate of 4.79%, and that hasn't changed. So costs are going up, but everybody's qualification ability hasn't changed.
Dave, that's helpful context. And before we let you go, anecdotally, can you give us a sense on what business has been like for you for these last few months? I mean, we see these monthly figures in the housing market, which would indicate there's a lot of activity. How busy have you been through all of this?
Well, like most mortgage professionals, we've been very busy the last few months. Interestingly, it's really a mix between existing borrowers who want to refinance their mortgages. Yes, we have lots of applications for purchases, but the problem in the GTA is there's lots of people who'd like to buy houses, but there's bidding wars regularly, and there's lots of frustrated buyers who keep showing up on offer night and just can't get that house. So in answer to your question, Jonathan, we're very busy. And of course, if you're taking the time to advise borrowers about risks and really thoroughly walk people through the important points they need to consider, then those are longer calls, and it makes for a longer day, but well worth it for anybody who's out there to really provide excellent mortgage advice.